Welcome everybody. My name is Bret Eberhardt. I'm one of the 4 partners here at A&I Financial Services, and we welcome you to the part 2 of our series on how to pay for college. I do have, for those that are new or may not know much about A&I, we are a firm that, we work with a small number of successful families. We help them grow and protect their investments, and then we let them choose how they want to be taxed. So we've kind of had that mantra for years, and it's worked out very, very well for our clients. At this point, I'm going to turn it over to my co-host, Marla Mason. She's been kind of driving this How to Pay for College series. And so Marla, why don't you kick it off and introduce our speaker for us?
Great. Well, first of all, I'd like to thank all of you for joining us today. And I think if you have a child in college or coming up on one going to college, or even if it's a grandchild that you want to participate with, that kind of thing, I think you'll find this very helpful. Our speaker today is Stephen Jobe, and Stephen has worked in the financial services industry for about 29 years and has been in the 529 space working on this type of thing since 2001, and he has extensive experience on both the distribution and the asset management sides. Prior to being with Mason, which he joined in October of 14, and as the head of the college savings business, he was responsible for Morgan Stanley's 529 savings plan business, and he's also been director for 529 with iShares, and was a board member on the executive committee, an executive committee member and a chair of the government affairs committee on College Savings Foundation in Washington, D.C. So I much appreciate his willingness to share his knowledge and expertise in this area to maybe help get kids there the cheapest way possible. So without further ado, I will turn it over to Stephen.
Thanks, Marla. Can everybody hear me okay? Everyone can hear me all right?
Yes. Yes.
Great.
Yeah.
Great.
You're good.
Just checking. Thank you. And thanks, Fred, in advance for helping me advance the slides. So welcome, everybody. Thanks for your time today. As I'm sure all of you know, college is expensive, and now college costs are beyond many families' ability to pay from current income or even savings. And of course, the financial aid process, which some of you may have already encountered, and even if you haven't, you've probably heard that it's wildly complicated. And so it's not surprising that many families feel overwhelmed, and as a result have put off saving for college. Some of us hoping for scholarships or financial aid in some form. Unfortunately, very often our procrastination results in a significant gap. So we're hoping to give you some information today that will enable you to better prepare for future college costs. So next slide, please, Fred. So today, we're going to do a few things. First, we'll look at the rising cost of college. And then when you fall out of your chair and get up, we'll then attempt to demystify the financial aid process. We'll look at a variety of college saving strategies and the advantages of each. And then lastly, we'll focus on one of the best ways, I would dare say, to save for college, and that's using a 529 plan. And we're going to dispel the myth that using a 529 plan will mean that you, your child, your grandchild, whomever, will not qualify for financial aid. So next slide, please, Fred. So why is paying for college so challenging for so many of us? Well, here's why. Next slide, please, Fred. So this shows us what the current cost of college education is today. That's 4 years of college at various institutions, and then what it is adjusted for inflation. And these are those numbers that I said would cause you to fall out of your chair. And these are averages. I just ran a proposal the other day for USC for a newborn, and it was going to be $750,000 in 18 years. Now that's using historical rates of increase over the last couple decades, which is about 5% on average each year. To be honest with you, I think it's unsustainable. I don't think that colleges, it's certainly not in the best interest of our country to have only the top 1% be able to save or afford college. But I also think it's unsustainable as a business model for most schools to price themselves out of so many families' ability to pay. So I guess the message is let's plan for the worst and hope for the best. But as you can see, it's going to be daunting, even if you're sending your kid to school next year, right? Based on these numbers here today. Next slide, please, Fred. So this shows the cost of various parts of the CPI, the index that measures inflation. And you can see the cost of a new car at the bottom there. Might be a little hard to see, but over the last couple decades, a new car, believe it or not, has only risen about 15%. And that's, of course, because of global competition and technological advances and so forth. The overall CPI, with all those components blended, has nearly doubled over that same period. Medical expenses, I don't need to tell anybody, have gone up most significantly. So you're paying about triple what you did over that period of time. And then that highest value at the top there is the cost of college. So, you know, if the cost of living continues to rise, but your income doesn't, that makes saving and planning for future expenses challenging, right? Next slide, please, Fred. And this is the result. Unfortunately, so what we've seen is in the last couple decades, this is really, you see this kind of hockey stick effect, right? That the cost of college has risen pretty steadily, and then all of a sudden it took off, and as a result, the college debt we've seen climb. It's over $1.5 trillion currently, and incidentally, that's more than all consumer credit card debt combined. So this is a burden that, unfortunately, again, not good for society in general, but you know, as an economic issue, I think it's already started to and will continue to mean that young families, maybe your child or your grandchild gets out of college and they put off marriage, they put off buying a house, and most of their disposable income goes to servicing their college loan debt. So that's not a good thing for anybody, right? So again, I hope this trend starts to reverse itself, and there are signs that it may. And this COVID, it may be a horrible thing on so many levels, but could be potentially a good thing for schools in the long run as they kind of reset and take advantage of distance learning and you know, have fewer kids actually on campus. I think there's a lot of things that are happening today that could result in lower college costs. So we'll hope for the best. Next slide, please, Fred. So for those of us who are planning to send our kids or grandkids off to college someday, but we wish to avoid an over-reliance on loans, there are a number of ways to close the funding gap. For many of us, a comprehensive strategy includes savings, such as 529 plans, which can provide a solid foundation. Then scholarships, grants, work study, if these are available to the student. And then if those two don't close the gap, student loans. If you're fortunate enough, you might be able to close the gap with current income to avoid entirely having to take out loans, but many of us are not able to do that. Increasingly, families are looking to their trusted financial advisor to assist them in developing a complete college funding strategy. I urge you to speak with Fred and Peter and Marla at some point after this presentation and to get their views on how best to achieve your goals. In the meantime, let's familiarize you with each of these ways to prepare for future college costs. Next slide, please, Fred. So what are the sources of financial aid? Let's start right there. Next slide, please, sir. So student aid comes in four basic forms: scholarships, grants, work study, and loans. The first three provide students with money at no cost, while the fourth, loans, both federal and private, of course, come at a price, right? So let's review each briefly. First, scholarship. So scholarship amounts can vary greatly depending on the type of scholarship awarded. We all think, including myself, that our kids, our grandkids are the brightest kids in the class, or the best athlete, or the best violin player. Well, my kids certainly weren't the best athletes, but I thought they were the smartest, and that was just because they were smarter than me. But the fact is, according to the author, Mark Kantrowitz, publisher of the scholarship and financial aid websites FastWeb and FinAid, which are great sources of information, by the way, less than 1% of full-time college students enrolled at four-year colleges received enough scholarship money to cover the full cost of college. So, you know, when we think of scholarships, we think of full rides, right? And if you're not only the best quarterback in the state, but one of the best in the country, then you probably will get a full ride somewhere. But the rest of us, mere mortals, probably not. 99% of us won't. All right, the second type, grants. Unlike scholarships, which typically require students to maintain certain requirements, such as a minimum GPA or a number of credit hours, grants generally come with no strings attached, but frankly, they're reserved for families of little means. So most of us are not going to get grants. Federal work study, these programs, which are administered by the school, but backed by the federal government, provide part-time jobs located both on and off campus for students who demonstrate financial need, and are generally available to many middle-class families and even upper. So this is not so much needs-based, but is a source of financial aid that if you are reluctant to take out loans, but need something to close the gap, either in the short term or over the long term even, this can be a great option. Of course, it also means your kid has some skin in the game, which is not a bad thing either. Next slide, please, Fred. The last form of financial aid is, of course, student loans. So loans, as you know, have to be repaid, and they're repaid with interest. And there are two types of loans. A federal student loan allows students and their parents or their parents to borrow money at interest rates which are generally lower than the prevailing commercial rate. And they often have flexible repayment terms as well, because, again, the program is subsidized by the federal government. Once upon a time, states used to write these student loans, but the federal government has taken over that part of the loan system. There are state loans still outstanding, and states are unwinding that business, but any new loans issued are from the federal government, not the state. And then lastly, a private student loan is one issued by a lender, such as a bank or a credit union. These also have more attractive interest rates generally, and some have flexible repayment terms as well. Next slide, please, Fred. So if you need financial aid, how does the federal student aid process work? Next slide, please, sir. So the application process begins by completing one or both of the following financial aid forms. The FAFSA, as it's called, which stands for the Free Application for Federal Student Aid, or the lesser known CSS profile, which stands for College Scholarship Service. Both applications can be completed online now, which is good news. When I did it back in the day, I had to fill out a paper form, but it's all electronic now. But I will tell you one caveat. There is a for-profit firm that sort of guises itself as the federal website. So if it ends in .com, you know you're in the wrong place. They were actually, I think they may have been forced to take that site down subsequently. You know, you spent 3 nights at the dining room table with all your financial forms spread out all over the table. And when you were done and you hit the button to submit, they said, please give us your credit card number. And of course, after spending all that time and energy, you weren't gonna go back to square one. So you acquiesced and you paid them their $79 or whatever it was. But as the name implies, the application that you should be filling out is free, the free application for federal student aid. So make sure you're on the right website. Next slide, please, Fred. All right, so let's take a little deeper dive into the FAFSA application process. Next slide, please, sir. The first step in the process is to complete the app online. And again, here's the website. It's studentaid.gov. And I believe Marla or somebody there will make this slide presentation available to you after the fact. So you needn't take furious notes here. We'll get you all this information by email.
We will take care of it.
Thanks, Marla. Next slide, sir. Thank you, Fred. So why do you need to submit yourself to this application process? It seems rather onerous, right? Because this is how the school determines a family's financial need and the extent to which you will qualify for either grants or work study or loans. And by the way, even if your child is as smart as you think they are, or the best, football player, what have you, to get any money from the school, you still have to fill out the FAFSA form. So in trying to determine the family's financial need, it's made based on a universal federal formula that it ultimately scores the family's need by establishing something called the expected family contribution, or as we call it, EFC for short. So the formula considers a number of things, primarily the assets and the income of both the student and the parent. And then they subtract the family's EFC from the cost of attendance. Every school has a posted cost of attendance. That's the full price to attend, right? And then that gap is the quote unquote need of the family or the student. Next slide, please, Fred. So what exactly goes into this EFC calculation that I mentioned? Next slide, please. Thank you, sir. You're getting my vibe here. Thank you, Fred. All right, so the EFC calculation takes into consideration, as I said, both the students and the parents' assets and income. Specifically, 20% of the students' assets, and most of the students don't have much in the way of assets, right? But if they have a bank account or an UGMA or an UTMA custodial account, 50% of their income, and if they just have a summer job mowing lawns, that's probably not going to add up to enough. But over a certain threshold, and it's fairly low, 50% of the student's income is expected to be contributed to the cost of college. So in most cases, that's not enough to pay for college, right? It was when I was a kid, but no more. For the parent, it's up to 5.6%. It is a sliding scale, but most of us are at the top end of that scale, up to 5.6% of non-retirement assets. So they don't want to raid your 401k or your IRA or your SEP IRA or your Roth IRA, but they're going to look at all your other assets, so your brokerage account and so forth. And then between 22 and 47%, again, a sliding scale that most of us are on the upper end of the parent's income is counted. So these four are the main factors that go into the EFC. We'll talk a little bit more about that in a second. There are additional factors such as how many children you have in your family, how many are in college at the same time. Those also have an impact on EFC. All right, next slide, please, Fred. So if your children, by the way, are not yet in high school or not anywhere near approaching college age, you can use a tool on the FAFSA website that estimates whether your family is likely to qualify for needs-based aid. The tool is called the FAFSA Forecaster. It's, of course, not as involved as the full FAFSA application process, so it's a little less onerous, but it is a rough estimate only. And of course, things are going to change between now and when that student goes to college, right, in terms of assets and income, and the cost of college. So that said, you're likely to be disappointed after running this calculation, but it might be a good way to prepare yourself for what is likely to be little or no financial aid. Next slide, sir. So for those of you who have a student planning to attend college next fall, you should be aware that the FAFSA application deadline was changed recently. Now families can submit their application in October instead of having to wait until January, which is what I had to do when my kids were applying to college. You might ask, why would I be in such a hurry to begin this tortuous process? And the reason is because the process is actually easier. Instead of having to estimate your income for the previous year and then amending the application after you file your taxes, now the FAFSA allows you to use your actual tax filing from a year prior. So for example, if I'm applying for the, let's say applying for the 21-22 academic year, then you would use your tax filing from 2019. So it's a 2-year look back. And the other benefit of this 2-year look back is that now you can hide assets, if you will, from and income from the school as part of this process. So we'll go into that in more detail in a moment. Next slide, please, sir. Actually, you know what? I do want to mention one other thing. The slide is not in this presentation, but you should know, for those of you who, you know what? Actually, to the extent that this next thing does not apply in Colorado, I'm going to skip over it. There is some legislation that was passed at the federal level that has yet to be adopted at the state level. So I'm not going to tease you, but I'll tell Marla and team as soon as it is passed, and then they'll be happy to pass along that good news to you. But in the meantime, we'll move on here. So what should those of you who are unlikely to qualify for any needs-based aid do? Well, of course, start investing early, right? Next slide, please. So what are the pros and cons of the various college savings vehicles available today, and how do they compare to 529 plans? All right, so prior to 1996, which is when the federal framework for 529 plans was created, most of us used, including myself, custodial accounts to save for college costs. Because of the potential income shifting, this was a reasonable strategy at the time, not not great, but the best available at the moment. But of course, this type of account only offers a reduced tax burden, whereas 529s are tax-free as long as you use the money for college. And perhaps more importantly, if the child doesn't go to college, I like to say they go to Vail instead of Yale, then they're still entitled to the monies in an UGMA or an UTMA once they turn the age of majority, whereas with a 529, the beneficiary has no access or entitlement to the account, not when they turn the age of majority, not when they go to college, not if there's money left over in the account. When they graduate from college, that money is your money. And we'll talk more about that in a moment too. Trusts, of course, are a common way for some more fortunate families to provide for the higher education of future generations, but they are costly. And like custodial accounts, they don't shield the earnings from taxes the way a 529 can. That said, you should note that a trust can be the owner of a 529 plan. We never recommend that you set up a trust to be an owner, but if you already have a family trust, you should maybe consider reinvesting some of that money in a 529. At least you can shelter that portion of the earnings from taxes. As you may know, if you have a trust, it's a very low threshold in terms of the earnings that quickly becomes subject to the highest ordinary income tax rate. So putting some of that money in a 529 would mitigate some of that tax bite of the trust. Savings bonds are now almost exclusively the vehicle of my great aunt, Harriet, who lived through the Great Depression and is still distrustful of the stock market all these years later. And I would argue that not only is the relatively low interest rate of a savings bond unlikely to offset the cost of college, but the so-called full faith and credit of the U.S. federal government is somewhat in question these days, especially as they continue to print money. And then surveys have shown that many families are still keeping the money for college in the bank. But if you expect the money will be used for college, why would you forego one of these tax advantage ways to save college and have it in a taxable account? And I don't know, frankly, any banks that are paying very high interest. So that's probably not going to help you close the gap anyway, unless you've got the whole thing wrapped up. All right. So I've had many people ask me, isn't it better to use a Roth IRA to save for college since it doesn't affect the EFC calculation on the FAFSA? Well, it is true that the value of a Roth IRA or any other qualified retirement account is not reported as assets on the FAFSA form, but a tax-free distribution must be reported as untaxed income on the student's FAFSA application. And remember, we said up to 50% of the amount of a student's income will be counted in calculating the EFC. But perhaps more importantly, and I suspect Marla and team would concur with this, tapping your retirement accounts to pay for anything other than retirement is generally a slippery slope. It's there if you need it, but it's definitely not the plan A, should not be. All right, so here we go. Second from the bottom here, penultimate, Coverdell Education Savings Accounts, once called Education IRA, which was a misnomer, but they were renamed for the senator who proposed the legislation, who has since passed. But Coverdells have really only one advantage over 529s now, and that's the ability to pick your own investment, such as an individual security. And that's because as a result of the tax reform bill, 529 account owners can now take $10,000 a year out of their 529 to pay for K through 12 tuition. Now, another caveat, unfortunately, Colorado has yet to adopt this at the state level. If you're not in Colorado, you can ask Marla if you're in one of those states that will allow you to do this, but Colorado has not yet brought their state enabling legislation into line with the federal. And as a practical matter, the current maximum annual contribution limit of Coverdells, which is $2,000 a year, makes reliance on this strategy, I would say, inadequate for just about any college, except perhaps maybe community college. So that leaves us with 529s, and you may be aware that they come in two flavors. One is prepaid, and the other is a savings plan. Prepaid tuition plans allow you to purchase tomorrow's tuition at today's prices. And that can be attractive, certainly in either a volatile stock market or declining market environment, as you can't lose money with these, right? If you're buying 3 credits, no matter how much they cost today, when you're ready to send your kid or your grandkid or whomever off to college, you can still buy those same credits. So they keep their value in perpetuity. But here again, the plans are only as reliable as the government, and in this case, they're state governments who sponsor them. And we've seen several of these plans stop allowing contributions or shutter the plan altogether. And by the way, there is no prepaid tuition plan in the state of Colorado. So that leaves us with 529 college savings plans. By contrast, they can be used to pay for other qualified expenses, not just tuition, which is what the prepaid tuition plans are limited to. And over a full market cycle, generally, these savings plans seek to rise at a rate higher than tuition increases. Remember, we said that tuition on average is increasing 5% a year. If you diversify and you're saving over a full market cycle, not 3 months, but 5 or 10 years, then you're likely to see that investment outpace the rise of college costs. And unlike some of the other vehicles that I mentioned, 529s have no income caps, no age or time restrictions. That's another thing about Coverdell's. You can't put any money in after the child reaches the age of majority, and you have to use it before they turn age 30. But 529s have no such age or time restrictions. And they offer tax-free earnings if the money's used for college, and that control that I talked about, right, where the beneficiary has no access to that account. So let's talk a little bit more in detail about 529s. Next slide, please, Fred. So here are the main features and benefits of a 529. There are many, but I want to touch on a few of them. So there are tax advantages at the federal and, in the case of Colorado, a generous state tax deduction. There are estate planning advantages, this idea of control that I mentioned, and then general flexibility, but it comes in many forms, which we'll discuss. And then lastly, less impact on financial aid than you would think. So let's go a little deeper on each of these. Go ahead, Fred. Thank you, sir. So let's look first at the federal tax implications, regardless of your state of residency. So contributions to a 529 plan are made after tax, unlike a 401k. However, you don't pay income tax or capital gains tax on the earnings as long as the money remains in the account. So unlike a taxable mutual fund, where even if you don't take the money out because you're in a pool of funds and the underlying securities are bought and sold and people are coming in and out of the mutual fund, there are capital gains that you pay, right? Or if it throws off income, you're paying tax on the income that mutual fund produces. But 529s are not taxed as long as you do not take the money out of the account. And when you do take the money out of the account, as long as it's used for quote unquote qualified college expenses, tuition, room and board. And by the way, it's not just the dorm housing on campus, but off campus housing. Even if you were to, let's say, either pay rent to an apartment not affiliated with the school, or you bought a condo in the town in which your child is going to school, you could, as long as the withdrawal doesn't exceed what the school posts as its annual cost for housing, you could use money in your 529 to pay rent or a mortgage or any expense related to housing. Again, as long as it doesn't exceed what the school says your child would pay, the most that they would pay. Fees, of course, are a qualified expense. Any fees that the school charges, not sorority dues, for example, that's not a school imposed, even though it's school related fee, but anything that the college charges. Books, of course, and any school required supplies. So if I'm taking a course that requires equipment, then that would be a covered expense. And then lastly, this is explicit in the code now. It wasn't always, but computers or any related equipment or service, all of that would be a qualified expense. And that's 100% tax-free at every level, federal and state. One caveat, again, I mentioned the K through 12 withdrawal. That is a function of the state in which you live. So if you have any questions about qualified expenses other than for higher education, talk to Marla and team, and they will give you the details of that. There are some differences from state to state. All right, next slide, please, sir. So let's look at the tax considerations at the state level. So more than half the states offer a state tax deduction if you make a contribution to a 529 plan, and the deductions range from a few $100s to unlimited, which is the case in Colorado. That means that if I have 10 grandkids and I open up a 529 account for $10,000 for each of my grandkids, I can write my income down by $100,000 for Colorado state tax purposes. So a really generous state tax deduction for those of you living in Colorado. Less so in other states. In some states, we call tax neutral. So they either offer no deduction or don't have state income tax. All right, sir, next slide, please. So in addition to the deductibility of your contribution to a Colorado-sponsored 529, there's been some recent state legislation passed that allows, if any of you are employers, you can contribute to your employees' Scholar's Choice College Savings Account and get a tax credit equal to 20% of the amount contributed, up to $500 per employee. So if your employee contributes $2,500 and you match, then you can get a credit for 20% of that. If you're an employee, not an employer, you should tell your employer about this if they don't already know, because it's a real generous benefit on both sides. All right, next slide, please, Fred. So for some of you, especially those of you who are grandparents, you might find the estate planning benefits of a 529 plan a bonus. Of course, like any other gift in the federal sense, you must stay within the annual gift tax exclusion limits to avoid having to pay gift tax. But what even a lot of accountants don't know is that you can take advantage of a special provision of the Internal Revenue Code, which allows 529 investors to in effect borrow from future years' annual exclusion. So you may know that currently the annual exclusion for an individual is $15,000, $30,000 for a couple filing jointly. So that means if you make a 529 contribution in excess of the annual exclusion, you can give up to $150,000 to each grandchild, for example, if you are filing jointly. And as long as you make no other monetary gifts to that same grandchild over the course of the next 4 years, then you pay no gift tax. So, for example, a couple with 7 grandchildren using this accelerated gifting strategy can get over $1 million out of their estate in one afternoon and not pay gift tax. Next slide, please, Fred. All right, control, I mentioned earlier. This is, I think, perhaps the greatest benefit of 529 plans, just after the federal and the state tax advantages. I get this objection all the time. People ask, what if the kid doesn't go to college, or I need the money myself? Again, the answer is the beneficiary of a 529 plan account never has any access or entitlement to the money, not when they turn 18, not when they go to college, never. In fact, you can even control the account from the grave. You'd name a successor owner. It avoids probate. and that beneficiary never gets the money unless you want them to. It's your asset. It's not the beneficiary's asset. So you decide how to invest the money, when to take it out, or even if the money is taken out at all. In the event the money isn't needed for college for the designated beneficiary, so you have to name a beneficiary. It can be yourself or your spouse, but to get the money out of your estate, it's got to be somebody other than you or your spouse. And so you designate that beneficiary. But you have the flexibility as the account owner to do several things, including change the beneficiary to anyone related to the previous beneficiary. And the definition of family was expanded years ago to include virtually anyone related by blood, marriage, or adoption. And that's not only sideways generation, but down one or more generations or up one or more generations. I'll give you an example in a second of why you might go up a generation. And of course, as I mentioned, the account owner need not ever, the account need not ever be liquidated because there is no age or time restriction except in one state, the state of Virginia. The account owner can also do one or more of the following things at any time. They can change the current allocation of the assets, and you can do that up to 2 times per year. So you're getting a little nervous about the way the market's acting. You can, seek safe harbor. We have a cash equivalent portfolio or a number of more conservative investment options. And then if you're now comfortable that the market has settled down, you can go back into some other investment type, and Marla and team can help you make those decisions and when to. You can transfer ownership of your account to anyone with no gift tax implications, provided you're not skipping a generation. So transferring ownership at any time has no tax implications. And then, of course, the account can be rolled over from one plan to another, again, provided you haven't previously rolled over in the last 12 months. So very portable. You like what you hear today about the Colorado plan, you go in and then something happens you don't like, you can roll over next week to another plan, no tax implications for that rollover. But this last option, make withdrawals, is a benefit that many don't fully understand. So as I mentioned before, a contribution to a 529 plan is a completed gift for gift tax purposes, instantly removing that money from your taxable estate. Yet, unlike a trust or some other irrevocable gift, assets in a 529 plan account can be taken back at any time and used for any purpose. Every penny of principal that you put into a 529 plan account can be taken back at any time for any reason, and not a penny of it is subject to tax or penalty. And that's because, A, if you're using the money for qualified expenses, it all comes out free from any tax. And B, if you're using it for something other than qualified expenses, so I have some need to tap my grandkids 529 and use it for myself for something other than college, that would be a non-qualified distribution, but only the earnings portion of a non-qualified distribution is subject to tax and penalty. So the tax and penalty only applies to the earnings portion of the distribution, not the entire distribution, and not all the earnings in the account. It's on a pro rata basis. So if my investment has grown from 150 from 100,000 to 150, 2/3 of it is principal. If I take $30,000 out and I use it for something other than college, 20,000 of that 30,000 is return of principal, 2/3, right? Same proportion. So that's returned to me free from any tax or penalty. And the $10,000 in earnings is the only portion that's subject to tax. What's also important to note is that if it is a non-qualified distribution and it's subject to tax, it's at the distributee's rate, not necessarily the account owner. So if I'm in the highest tax bracket and the beneficiary is in the lowest tax bracket, then it makes sense for me to have the check made payable to the beneficiary, whether I'm giving them that money or not. I can still do that, and then I'm effectively income shifting, right? I'm lowering the tax burden of that withdrawal. So in the event of a non-qualified withdrawal, make certain that the person to whom the plan manager makes the check payable is in the lowest income tax bracket, provided it's not going to adversely affect them from a tax bracket standpoint. All right. You know what, Fred, before I move on to the next slide, you can leave it up there, but I did want to give you one example. I mentioned that you could change the beneficiary up generations, which may seem, counterintuitive to you. So here's an example of how flexible 529 plans are. So let's use my earlier example of $100,000 growing to $150,000, and let's say my daughter ends up going to public school instead of private, and she uses $120,000 of that money. We've got $30,000 left over. Again, no age or time restriction in the Colorado plan, right? So I could leave that money in perpetuity and give it to my daughter's kid when she eventually has children. Or, of course, change the beneficiary, back to myself. I could take golf lessons as long as the school accepts federal student aid. That's the litmus test. So if I take golf lessons at Arizona State University, for example, that would be a qualified expense. Even if I only take one course, you don't need to be a full-time student for it to be a qualified expense. So lots of flexibility. Let's just say I'm a scratch golfer, which is fantasy, but let's just say for this example that I don't need golf lessons. And since my daughter got such good grades in school and she never got arrested at any of the sorority parties she attended, I'm going to reward her by giving her the $30,000 that's left over in the 529 plan. So if I do that, and I have the check made payable to her and she's right out of college in the 10% bracket, that $30,000, again, comes out pro rata. So $20,000 is principal, no tax or penalty, $10,000 earnings. She's going to pay ordinary income tax at her rate on that $10,000. She's in the 10% bracket, so that's $1,000 tax, and then a 10% federal penalty, another $1,000. So $2,000 tax and penalty on a $30,000 withdrawal on money that's been earning tax deferred for 15, 20 or more years, and she's using it to buy a condo. So very flexible. But here's the example of changing the beneficiary up a generation. So I call up like Mason and I say, please change the Benny from my daughter to my mom. Why? Because my mom now is disabled. She needs some money for medical expenses. She's on a fixed income. So they change the beneficiary, and I say, and after you change the beneficiary, please send my mom a $30,000 check, flatten my account, and give her all the money. So they do that. So what does my mom pay in tax? Again, like my daughter, she's in the 10% bracket, so she's going to pay that same $1,000 federal tax because she's using it for medical expenses, not qualified education expenses. But you should know there are 4 exceptions to that 10% federal penalty. So they are, God forbid, death of the beneficiary, disability of the beneficiary. So my mom is disabled, and you don't have to be disabled when you set up the account. Any beneficiary at any time becomes disabled, they would be entitled to this exemption of the 10% penalty. So she's going to pay $1,000 in federal income tax. She lives in Florida. She pays no state tax, and she pays no federal penalty. So here again, money used for something other than college, $1,000 tax on a $30,000 withdrawal. Money used for something other than college. So very, very flexible. The other 2 exceptions, by the way, are your kid really is as smart as you thought they were, and they get a full ride. Scholarship is one of the exemptions. So if the school costs $25,000 a year, and I have $100,000 in my 529, I can take $25,000 a year out of my 529. I will pay tax on the earnings if I buy a boat or a Porsche, but I wouldn't pay that 10% penalty. And then lastly, military school. Kid goes to West Point. Obviously, they're not going to pay anything for that education if they do their time in the service, but there is a value associated with that. And if they don't do their time, they would have to pay that. So that is the amount that I can take out of my 529, just like a scholarship, without having to pay that 10% penalty. All right. So we've discussed some of the flexibility. Again, no income limits, no age or time restrictions, again, except if you are in the plan sponsored by the state of Virginia that has a 30-year limit. No other plan does. And anyone with a tax ID can open an account, and anyone can contribute to someone else's 529 account. So I could have an account in Colorado, and my brother in New York can contribute to that account, and I can get the state tax deduction. Isn't that slick? Instead of your kid or your grandkid getting a bunch of plastic toys for their birthday, ask your relatives to consider making a contribution to their 529 plan, and they can give them some token gift that makes the kids smile, but they'll forget about that tomorrow anyway, right? And that 529 will just keep on earning and provide a lot more value to that child, right? Then lastly, again, the litmus test for determining whether or not the expense is qualified is if the school accepts Title IV federal student aid. So not only does your child not have to go to school in Colorado or wherever they live, but there are thousands of schools, colleges, universities, vocational schools, trade schools that qualify. Even hundreds of schools outside the U.S., McGill in Canada, Cambridge in the U.S., in the U.K. rather, they accept U.S. federal student aid. So if you have any questions about that, you can go to the FAFSA website or ask Marla and team, and they can tell you whether that school would be qualified or not. All right, Fred, next slide, please. So we talked about financial aid. How do assets in a 529 plan affect your chances for qualifying for federal student aid? So 529 plan assets, this is a little counterintuitive, but they're treated as a parental asset. And that's because, again, remember, as the account owner, I control those assets, right? Not the student. So 529s are treated as a parental asset. And remember what we said earlier when we're looking at the EFC, expected family contribution, the maximum of a parental assets that are expected to be contributed to the cost of college is 5.6%. Distributions from a 529 are considered income. However, provided a parent is the owner of the account and the beneficiary is the student, a distribution is not counted as income. But here's the little known fact. If the owner of the 529 plan is a third party, meaning someone other than the parent or the student, such as a grandparent or another relative, it's even better in terms of the EFC because remember, they're only looking at the assets and the income of the parent and the student. So the assets held by grandma will not be counted in the EFC calculation at all. Now, again, remember I said a distribution is considered income to the child, right? So later on, when grandma takes the money out and gives it to the kid or the parent or sends a check directly to the school, that's counted as income of the student up to 50% in the EFC calculation. But think back to our earlier discussion of the FAFSA application process and the timing of the tax reporting, because that look back now is 2 years. And so a distribution from, for example, a grandparent's 529 account made during the student's junior or senior year in college wouldn't appear on the FAFSA application at all, right? Because by the time you'd have to put that on the application, the kid's out of school unless they need 5 years to get a 4-year degree, as some kids do. But again, because of that 2-year look back, if you wanted to hide those assets in a 529, even though, again, only 5.6% is going to be expected to be contributed to the cost of college, right? So if a $100,000 account, 529 account, only 5,600 of that maximum would be expected to be contributed to the cost. But if you want to make that 5.6 go to zero, then a grandparent or an aunt or uncle or somebody other than the parent can be the owner. And then if there's other sources to pay for college, then use those for the first 2 years. And then in the junior year, after you've applied for financial aid, so call it November, December, you can have grandma or whomever owns that 529 account write the check to the school or the kid or you as the parent. And then again, that wouldn't count as assets or income. Now, if there isn't any other source, you can have grandma open the account and then transfer ownership to the parent before they submit the application for financial aid in the freshman year. And that way, it won't be considered income to the child. It'll be the asset of the parent. And again, 5.6%, right? So that's how you can either hide or mitigate the effect of a 529 as it relates to the expected family contribution. All right, so next slide, please, Fred. Maybe my phone is a little latent here, but we should be on a slide. Yes, next one. You know what? I think I have a different version, but I can. Yeah, you know what? Keep going, Fred. Sorry. There we go. Thank you. Thanks everybody for bearing with us with our technical difficulties here. So the bottom line is this: 529 plan assets do little to hurt your chance of receiving financial aid, but honestly, most of us are not likely to get much needs-based aid. You might get merit aid, but probably not much, if any, needs-based aid. So unless you already have a trust for the child, or your child really is as talented as you think and will get that elusive scholarship, or you can pay for the cost of attendance out of current income, which is a stretch these days, then you should consider funding a 529 plan to help fill the gap and possibly avoid having to take out student loans. And we'll let Marla and team speak with you about those possibilities. All right, so if you skip a couple slides, Fred, here, just note, I'm not going to read any of this stuff off to you, but here's some resources that you might find helpful. Information about scholarships, grants, and work study, and some of the levels of subsidized loans and so forth. But Marla and team can help you work through that. I'm going to skip my normal pitch for my product, and I'm going to open it up to questions. So with that, Marla, if you want to see if there are any questions from the audience.